Saretsky here. Welcome back to the show. I got a few things to touch on this week. I want to give you an update on what's happening with Canada's inflation data. We just had the latest numbers come out. What that means really for the bond market, mortgage rates, of course, which are following along. Remember, 60% of Canadians are renewing a mortgage over the next 24 months. So this kind of data is incredibly important. I'm going to give you some intel on what's happening, again, in the condo market, but more specifically in the shadow inventory market. This is data that we have collected behind the scenes through subscription services, things of that nature, as well as a lot of conversations that we have with people in the industry that are very well connected, that know their stuff. Of course, we bring all this information to you for free. So hopefully if this brings you any sort of value or entertainment, you hit like and subscribe. So let's talk about inflation data in Canada, coming in pretty much on the screws as expected, 1.9% headline inflation on a year-over-year base. Now, what it's interesting is to kind of parse some of the data. Core inflation remains sticky, just over 2 at about 2.2%, giving the Bank of Canada at least a little bit of pause as to say, okay, well, if we're going to continue to cut rates, how quickly do we need to do this? Can we take our foot off the gas? And that seems to be what the markets are thinking. Markets are now saying no rate cut. So financial markets, right? There's basically pricing or betting markets in financial markets. And there is essentially a bet that there is going to be no rate cut in March. But markets are still pricing in about 2 cuts, 50 basis points in total for the calendar year. So that's kind of the expectations. And again, those expectations can change depending on what happens largely with this tariff war is really going to dictate the direction for the central bank. But inflation coming in, maybe a little bit, I wouldn't say sticky, but starting to sort of show that, okay, maybe it bottomed and are we going to start to tick up here? That's certainly what my friends over at the Loonie Hour have done through their modeling, really at Rich Diaz through the ICE cap inflation model, suggesting that inflation is going to bounce higher later this summer. When we look at what's happening in some of those little interesting data points, is Stats Canada still has rent growth running at 6% on an annual basis. So they're still saying rents in Canada are up 6% from last year, but they finally recorded their first month-over-month decline in rents in a long time. So what this is basically saying is the Stats Can mental data lags. It's finally looks like it's just starting to make the turn. And you'll see that CPI rent growth on a year-over-year basis probably turn negative at some point later this year. Of course, we know, for those of you who are paying attention, if you're in some of these large major metros like myself here in Vancouver, or if you're over in Toronto, we're seeing out in parts of Calgary, where rents are actually declining on an annual basis, upwards of about 10% in markets like Vancouver and Toronto. So the softness and the weakness in the rental market is very obvious to those that are paying attention. And of course, this has significant implications moving forward, again, for the investor market, right? Again, we talked about this investor market here many times, and it is a core theme for 2025. It's a market that's going to struggle. So regardless of all the noise and all the stuff that's out there, there's 2 markets today, okay? There's a resale end user market and there's an investor market. And those are 2 very different markets. And one is basically a discretionary purchase, right? As an investor, you don't need to purchase a second condo or a third condo or add to your rent portfolio. You don't need to do that. But as an end user with a growing family, in many cases, you need to upsize, or, you get a new job and you need to move. So those are sort of the end user type of bids. That market is still churning and is still churning just fine. It's really the issues are in the condo market. Now, you'll remember a couple videos ago, I alluded to what's happening in the condo market. And you look specifically here in Vancouver. Remember, I just said rents are down 10% year over year. So what does that do? Well, at some point when you've seen no growth in the condo space over the last, basically call it 3 years, now you see declining rents. More and more investors are saying, okay, maybe it's time to exit. Well, I mean, realistically, they should have done that probably 12 to 18 months ago, but they're looking to exit now. So you could look at the number of new listings in the month of January, we had an all-time high in Greater Vancouver. The number is really off the charts. Almost a 25-year high in the number of new listings, condo listings hitting the market in Vancouver. And we've talked about the weakness in the pre-construction market, again, which is a market that investors dominate. Roughly 65 to 70% of all pre-construction units sell to investors. Okay, why do they sell into investors? Because most end users, they don't want to wait 3, 4, 5, 6 years to move in. Most end users that have money and are ready to go, they want to move in 2 months. They don't want to wait 6 years to potentially move in. Not only that, but think about it, is like you're buying a floor plan. You go into a presentation center and you're buying a floor plan. So you can't kind of walk around, look at it, check out the view, who are the neighbors, start touching all the appliances and testing everything. So you can't look and feel. And so most end users, again, if you're going to live in a unit, you want to be in it. You want to see how you feel in it. There's that emotional side. So the investors that are basically buying a sheet of paper, it's obvious why they account for about 65 to 70% of that market. So we know that market is struggling. We know that the resale market is struggling. And we know that there's a record number of units, condo units, that are currently under construction right now. Not only that, but you've got a record number of rental units under construction. So that's going to put more pressure on the rental market as its supply completes and enters the market. And of course, for all that, so as the developer, how do you get investors to step up to the plate today? Not only with the uncertainty around tariff wars, but the federal government telling you population growth is going to 0 over the next 2 years. We've got an election coming up, and you've got declining rents and falling condo prices. Pretty hard to get people to step up. And so what you're seeing is more and more developers trying to offer incentives. You're seeing deposit structures coming down from, hey, you got to put 15% down on this condo, where you get them down to about 5% now in many, many cases. Of course, you just have to go out and ask. But so deposit structures are coming down to try to get people to say, hey, listen, you put down 5%, this unit completes in 4 years. You're kind of rolling the dice here, but it's a low risk. You're putting down 5%. That's the message that is coming from the developers. Now, the developers are starting to sit on what I call shadow inventory. If you look at, this is data that's compiled by Altus Group. It's a subscription-only service that I subscribe to. We go in there, we compile the number of unsold units. This is essentially the number of condo units that are actively being sold at presentation centers. Maybe the developer has not yet dug the hole, but they're actively selling at presentation centers. So they've got some inventory there. And then you have units that are currently in the construction pipeline. They're being built, and again, they're unsold. So the number of unsold condo units is hitting highs that we haven't seen going back to 2017. So this is shadow inventory. And why is it shadow inventory? Because this is inventory not on the MLS system. So when you go look at the number of new listings hitting the market in January, or you go look at total inventory for sale, it doesn't include the number of units unsold at developers' presentation centers, because they don't sell these units on the MLS. These are all marketed offline. Think about it. If you're a developer that is selling a building with 200 units, you're not going to flood the market and just dump 200 units on the MLS system. I mean, you just flood the inventory, flood the market. So these pre-sales have always been done off market. You got to go into the presentation center. They'll tell you what you have. Now, typically speaking, developers hold back a percentage of units. It depends on the developer, but very rare is the developers sell through the entire building, 3-4 years out at the pre-construction presentation center. Why? Because they need to hedge. They need to hedge the risk. If you pre-sell the entire building, and all of a sudden during the construction phase over the next 2, 3, 4 years, your construction costs balloon out, you just wiped out any potential profit, right? If commodity prices, lumber, concrete, copper, et cetera, or costs of financing moves higher as it has over the last number of years, if you've already pre-sold all your units and suddenly you have a spike in costs, you basically eroded any profitability in that project. So many developers will hold back units and say, okay, well, if I hold back these number of units at completion 3 years from now, they should be worth a little bit more. And that will sort of hedge myself from any downturn in the market or uptick in, say, commodity prices, cost of construction, etc. So this is important because people say, oh, all these developers, these greedy developers, they are struggling to get off the market. If you cannot sell, there's a thing in BC called REDMA, the Real Estate Development Marketing Act. If you cannot sell all your unit, so in order to get construction financing, the bank says, listen, we'll give you money, but we want to see that you sold 60, 65, 70% of the building up front. You've got to sell, call it 60% of the units. The REDMA Act says you have 12 months to do that. You have 12 months to sell those units. Okay, so if he's a developer, he said, well, do I really have confidence I can sell 60% of the building in the next 12 months in a really down, soft market? So you're seeing a lot of developers, the ones that have the ability, many don't, the ones that have the ability to prolong projects and sit on the ground, sit in the dirt for the next couple of years, they will prolong that because it's not worth running the risk of launching a marketing and sales campaign only to fall 10 or 20% short of your target, and you just wasted a whole bunch of time, money, and energy. And so you have it on good authority here is the BC government will be making an adjustment to the REDMA Act, allowing developers to go from 12 months to 18 months. So the BC government is effectively going to say, listen, we're going to extend that from 12 months to 18 months to give you the opportunity to sell those units and hopefully get more supply coming off the ground and being actually constructed. So that's really what's happening in the weeds of the development community, of the development space. Again, keep in mind, as I've highlighted, you've got condo prices that are flat to declining, rents that are declining, record number of new listings hitting the resale market, a record number of shadow inventory on the market. The pre-construction, the investor type of market is going to continue to struggle in 2025. I think that one's a pretty easy, obvious call to make. You'll see more developer distress, probably more bankruptcies this year as well. So that's a space that I'm going to be following very, very closely. Again, I think the changing of the REDMA Act is necessary, but it is also indicative of the conditions that we are currently in. And again, that I don't see really improving this year. And this is why when we talk to people that reach out to us and say, hey, I've got this unit, this investment unit that I want to sell. Well, I've been waiting for better prices. Maybe I'll just hold on and wait. And I say, well, because they give you, rates are down, prices should be going up. Well, yeah, rates are down from 6, but they're still double what they were over the last decade at 4%. And meanwhile, you've got a record number of basically supply hitting the market. That's why your prices haven't adjusted higher. And so, and this is important to understand because, again, most people don't have the data and the intel like we do to actually go out there and give advice to clients to hopefully make good decisions. So hopefully that helps. Again, if you're in some of these situations, happy to chat. Again, I do this for a living, buying, selling real estate. So you can feel free to reach out to me via email, and that's where we'll do all of our due diligence for our clients. So as always, I hope this helped, and we'll see you next week.